Welcome back. We are in conversation with Manas Shukla of Edelweiss this week to understand the concept of ETFs and whether they merit a place in your portfolio. Manas, so let's get down to basics. I mean, why an ETF? The first question that will come to mind is, oh, but if I just want to, mirror an index, I can also look at perhaps an index fund, right? So what are the merits of choosing an ETF over an index fund?
Surabhi, the point is that an ETF, actually, there are two elements. Number one, ETF is a very low cost product compared to a normal index fund, which are commensurately a little high.
We're talking about management fees, etc.,
exactly,
the AMC
exactly,
fees.
Exactly, the running fees of the product. Apart from that, in case of an index fund, as I pointed out, it is not in multiples of baskets. So what happens is, as a fund manager, I might have, say, 27 lakh rupees. Right, outstanding. So that would not build a complete Nifty basket for me.
Sure.
Right. So I would not be exactly mirroring the index. It would be a deviation, which is normally called as a tracking error.
Okay.
Right. So normally index funds have a higher tracking error because they are not exactly as in the back, as in the what I mentioned specifically to in the form of a basket or in the form of a drawer. So I might not have a single drawer. It's like clothes lying everywhere.
Okay.
So
okay. Because you don't have the sufficient funds, perhaps at that point in time, to create a full additional basket.
Exactly. So I accept amounts of 5,000 rupees also in that. So if I'm getting a 5,000 rupee, I can't buy a Nifty basket in 5,000 rupees.
Absolutely.
Right.
Okay.
So it is basically, that is where the tracking error actually is high.
So lower cost and lower tracking error. How low are the costs typically when you're talking about an expense ratio of an ETF vis-a-vis a regular actively managed fund which has a fund manager picking stocks? What's the usual difference in costing?
It's roughly 1/5 at least. For example, normally all ETFs in India normally run at a highest expense of around 40-50 basis points, whereas mutual funds, is around 2.5%. So effectively, it is 1/5 the cost of a normal mutual fund, and that's more or less it. So effectively, that 2% differential actually translates into return for the investor.
Absolutely, sir. That is quite a bit of a cost difference. But now let's talk about the difference between the two approaches. Active investing, when you're going and buying into or investing into a large cap fund or a mid cap fund, as opposed to investing in an index fund or an ETF, which is simply going to replicate, best case scenario, replicate the returns of that index. So why not go in for active investing? What are the merits of being with an ETF?
I would not proclaim that you should not go in for an active investment. It is basically a mix of both. So, in fact, if you see the alpha generation over Nifty for large cap products roughly 10 years back was around 7 to 8%, which is now contracted to around 2 to 3%. So, with the spread of knowledge, with the spread of research, right, in the large cap domain, in the large cap companies, it becomes very difficult for any fund manager to create a significant alpha.
Because everybody has the ideas, everybody's researched the new theme or the new concept.
Everybody has the same data available, right? So it is upon your own interpretation, right? So it becomes very, very difficult over a period of time to actually outperform the broader indexes. That is where basically the ETF has flown, has come into being, and that is where it has come into being globally. So even if you're talking in terms of US and other markets, large cap is predominantly denominated by ETFs, right? So if I have to generate a 1% alpha post expense, and if I have a smart index which is ready to do it without an expense, why not?
So you mentioned large cap indices, and as I said, out of the 45 odd indices, majority continue to be focused on the Nifty or on the Sensex or the Nifty Junior, or as that index now is called, the Nifty Next 50.
Next 50, yeah.
But I know that you've come out with a different product off late, and it has something to do with quality. We keep hearing the idea of more strategic ETFs, so strategic index funds now.
Right.
Explain this to us. We hear about the NV20 index, which the National Stock Exchange has, and also this Quality 30 index. So what are these new indices all about, and are they better than the Nifty 50?
Surabhi, I would like to take a step back. I would basically tell you the factors which are used in any investing, be it any active fund manager or any passive fund manager. There are certain factors based on which he shortlists data, he shortlists a stock. And that basically determines whether the stock would form a part of my portfolio or not. These primary factors are quality, size, First one is size rather, because you know what is large cap, mid cap, small cap. Then you have quality. Quality is basically factors which are intrinsic to the company, which is irrespective of the price of the company. Then you have value. Value again is a price multiple, whether I'm getting it at a reasonable price or not. Then you have momentum, which is basically volume driven. At certain point of time, certain sector is doing good, so should I participate in that sector? Then you have volatility as an element, and last is dividend. So these are the 6 parameters based on which globally any fund manager actually allocates his stocks.
Sure.
Right. India till now was only the size factor, right, which was Nifty and Sensex are pure size products. Free float market cap, large stocks automatically get into the picture. Then obviously now we also understood that globally factor indices are doing very, very well. Last year, majority of the global flows have gone into so-called smart beta products, which are basically indexes which are factor based or multiple factor based. India also, I mean, last year NSE actually started coming out with these factor indices, which was NV20, which was basically a value-based index, and the one which we have just come out a product on, which is the quality index.
So I'm going to stop you there. NV20, I mean, just for viewers who don't understand this term, relatively newer, of course, on the investment horizon. NV20, which is an index that has been created by the National Stock Exchange. I'll list out some of the constituents. Most of them, of course, I'm guessing are anyway on the Nifty 50, all these stocks. So you've got the likes of an Axis Bank, a Bajaj Auto, a BPCL, you've got Bharti Airtel, Coal India, GAIL, HCL Tech, ICICI Bank, Infosys, ONGC, I'm seeing Reliance here on the list, TCS, Tata Steel. So, I mean, basically, it's like a subset or a mini basket of the Nifty 50 itself. Now, explain this whole concept of the value investing, and then we'll talk about quality and how the two are different.
See, the universe specifically selected in case of NV20, if I'm not wrong, is the Nifty 100 stocks. Now, what happens is, like in case of a size, the bigger stocks automatically have a higher weightage. Here the difference is the stocks which have a better valuation have a higher weightage.
So if it's relatively cheaper, if it's a good stock, if it's relatively cheap, then it will have a higher place on this index.
Exactly. So it would not just be the size factor which will be important. It would be whether the price is, I mean, the stock is available cheap, it is available commensurately cheap with the industry, with its peers, and that is where it forms a higher weight in the index. That is primarily the crux of these factor indices. I mean, quality, for example, even if you see, it is like the stocks which have better quality perspectives would have a higher weight.
So I'm coming down to the Quality 30 index, because that is a new product that, of course, for the record, Edelweiss has also launched. And again, I'm seeing, apart from a lot of the large cap names which are already there, like the likes of Maruti Suzuki, HCL Tech, Tata Motors, ITC, TCS, Infosys, I'm also seeing some names beyond the typical Nifty 50 list which are there. Page Industries, for instance, Exide Industries, Imami, some of these stocks which are not the largest of large caps in the Indian market right now. So how does quality work?
Quality index is basically derived from Nifty 200, which is primarily top 200 stocks of the country, based on free float. Now Nifty 200 is actually now full market cap index, but the erstwhile Nifty 200, which was the free float index. So based on which, of the top 200 stocks, first filter is basically taking out stocks which are not liquid, because ETF requires liquidity, right, of the underlying as well as the units. So non-liquid stocks are removed. Out of those, once the non-liquid stocks are removed, then the filter criteria is actually put into place. Now, the filter criteria out here is return on equities, right? Debt to equity is one of the criteria, and the third is profit growth. The growth in profit in the last 3 years. So you have ROE, which is 40%, you have debt to equity, which is 40%, and you have profit growth, which is 20% weight. Based on that, a formulation is done, and the weights are actually assigned to most of these stocks.
Sure.
So important to note out here is we are not considering the price of the stock out here.
Right. You're only looking at quality as a factor.
Exactly. So these are globally termed as growth stocks. So in any emerging economy, growth stocks tend to perform better than value stocks. Value stocks in a growth economy, in a already grown economy, tend to perform better actually.
Okay. So that's the Quality 30 index. Are returns always completely equivalent to the underlying index, or is there some plus minus margin for error?
That's a very good question, Survesh. What happens is in India, normally we always evaluate any performance to price index, which we see on the exchange. I mean, Nifty running at this price.
Yeah.
But
So if Nifty has gone up 7% in a time period, I want my ETF to definitely give me a 7% appreciation. That's the broad thinking.
Exactly. However, you would be surprised to know if you're comparing it to the price index, you might actually get better returns in an ETF.
Okay, how is that possible?
Right. Because there is always a dividend yield, which actually does not take place. I mean, does not reflect in the
underlying
prices,
index,
in the prices which you see on the exchange. So when you invest in an ETF, that already has that dividend criteria built in. So it would obviously have the dividend yield built into your returns. So once you're invested, you say, example, the Nifty dividend yield is roughly around 1.5%, and just assuming that the interest is around 0.5, the expense of the product is around 0.5%, you get a 1% over and above Nifty return.
Okay, on that note, we're going to take another break. Now that we've understood the product, the philosophy, the idea behind ETFs, the question is how to balance it out in your portfolio, and of course, where the future lies. What sort of growth can we expect in ETFs as a product here in India? We'll talk about that after the break.